All right, see if this thing works. So in Chapter 1, doing a review for the exam, and Chapter 1 is kind of the basics where we start the building blocks of what's going on with the accounting cycle. This is the first of 4 chapters. We talk about the entire accounting cycle. And so the major points we're going to cover here is trying to go through and look at what the 3 activities are that accounting provides, what it's trying to cover. And they're on page 4, and they're talking about identifying what's going on in the economic events. So you have to identify what the events are. And then after we've gone through and done that, we have to go through and try to figure out how to record that information. So we have to analyze it, and then we have to figure out how to put it into an appropriate grouping. So that's what we're going to do with the accounting cycle. We're also going to go through and talk about each one of the economic transactions of a business. We're going to use the accounting equation and analyze and see how we do double entry bookkeeping. And then finally we're going to go through and talk about the 4 financial statements that are at the end of the chapter, where we take all the transactions happen during a month, and then we try to group all those thousands of transactions into something that's summarized enough that you can actually interpret and see what the financial statements are. So this is kind of that first level of looking at things. So they start off talking about what the 3 activities are on page 1, or page 4. That would be good to know. They talk about internal users. I'm not going to spend a lot of time between internal and external users. You can read that, but internal users are the people inside the business. External users are the people outside. So it's creditors, it's investors, it's people who want to understand what's going on. That's why financial accounting is set up, is so that people outside the company who don't have inside information can go through and see what's happening and interpret the results of the company when they have the financial statements. We really start to get into the concepts and assumptions of accounting over in page 9. And they talk about generally accepted accounting principles as being kind of the rule book, if you will, for how we have to go through and follow the rules. The reason for that is we want to make sure that when we have records that are put together with people, that they can interpret them from outside. So we follow the same set of rules for pretty much all of the accounting. They talk about some principles. These would be useful to know on the exam on page 9. They talk about historical cost principle versus fair value principle. We typically go through and record things using the historical cost, what we paid for them, because that's objective. They talk about financial information to be useful should be relevant. In other words, it's something that can be applicable to a question. And there should be faithful representation, meaning that the numbers and the descriptions should actually reflect what really occurred, so it'd be useful to know those items. The assumptions they have over on page 9 are useful. Again, these are kind of the building blocks. The monetary unit assumption, we assume that we're recording transactions in dollars, United States dollars. So if you don't have something that can be recorded in financial numbers, it's probably not a journal entry, it's not an accounting transaction. The economic entity assumption talks about the idea that the transactions of a business are separate from its owners. So we want to make sure that all the transactions of a business are grouped together so we can see the results of how that business is doing. And they talk about some of the different types of businesses, proprietorships, partnerships, and corporations. Probably should know a little bit about the differences of those, but that's really more of a biz law, so I'm not going to beat you up too much on the details that you need to know there. But you should be familiar with those. Where you really start to get into the accounting area, though, is over on page 12, where we start to talk about the accounting equation. And the accounting equation is really kind of where accounting starts to go away from being just math and numbers to being a language. Because we talk about something called assets, liabilities, and then something called owner's equity. Here they call it stockholder's equity. Make sure I use the right term. And the accounting equation is where we're trying to go through and group together what the accounting transactions that occurred during a period of time are all put in one place. And so when we talk about assets, we go through and we talk about assets as being a resource a company is going to be able to use. It's something that's going to be able to utilize for its benefit in the future. And so I like to think of an asset as something that a company owns. And that might be cash, that is going to use to pay for bills. It might be inventory that it's going to sell to customers in the future. It might be a truck that it's going to use to make deliveries, but it's something the company is going to utilize. Liabilities are obligations to pay, a promise to pay something in the future. So I like to say that's what the company owes. And so you have a promise to pay something in the future. Maybe you've borrowed money, so you have to pay the bank back. That's a liability. Or another word for that would be payable. You have to pay it in the future. Maybe you have employees that work for you and you haven't paid yet because you haven't got to the pay date. You only pay them every 2 weeks. So you have to go through and you have to calculate how much you owe them at the end of the month because you don't pay them until the first part of the next week. Maybe you have taxes that you owe to tax authorities. All those are obligations a company's going to have to pay in the future. Okay? And these items occur whenever there's some sort of an economic transaction that's occurred, where there's an exchange of value. Like either you've received something and you have to pay for it, or you promised to do something, you're obligated to take care of that. The difference between those items is what I like to call, think of it as net worth, the value of the company. You could go through and you could change the equation around and say assets minus liabilities equal stockholders' equity. If you took everything that the company owned, turned it into cash, paid off everything that the company owed, so it didn't owe any more liabilities, what would be left over would be the net worth of the company. Okay? And they talk about this on page, they go through the expenses and everything and liability definitions on page 12 and 13. But what's really important to keep in mind is that basically the assets are what a company uses to operate in its business. It gets those assets from one of two places. Either it gets that from the owners putting in the value, we call that the residual value, or it gets it from the liabilities that it's incurred. So that's one of the two ways that a company is going to be able to get an asset. So the reason we do this equal sign is because that has to do with the concept of double entry bookkeeping, where we're going to make sure that every time we change something in one account, it's going to be balanced on the other side. So if an asset goes up, if you get a truck, you got that by either borrowing money, by somebody contributing it, or you might have got it by using cash, which truck value went up for the asset, but the cash went down. So there's always going to be an offset whenever we're using transactions, and this accounting equation kind of sets that up with the equal sign. They also talk a little bit over on page 13 about revenues. Revenues are just simply the money that you get whenever you sell a product or you provide a service to a customer. It's money you get from your operations. Expenses are the items that you pay for those operations. So you pay the cost of doing business, either a salary or buying inventory or and selling inventory or paying for utilities. Okay, they decrease the value of the company, whereas revenues increase the value of the company. See where I'm at. Okay, transactions over on page 14, they talk about the business transactions. As I said, you're only going to record something in one of these accounts if you go through and you actually have an exchange or promise of economic value. So if a customer just comes in as shopping and asks you for a price quote, you haven't sold anything, there's no obligation there. So that's not going to be recorded. It's only going to be if they buy it. So if they give you cash and they walk out with a product, economic exchange of value occurred, you're going to record that transaction. On the other hand, what happens if they come in and they buy it, but they promise to pay you in the future? You didn't get any cash. You have something called an account receivable. We'll talk about that in a later chapter, but that's basically an exchange of economic value. They took your merchandise and they promised to pay you, so you would record that. So when a transaction occurs, you have to go through and you have to try to figure out how to group it together. And over on page 15, they talk about that. We're going to go through and talk about some of these different transactions. But before we do that, I want to use this here example of the accounting equation to try to go through and expand and show you a little bit about the debits and credits. That really kind of comes up in chapter 2. But I like to do it now. I think it makes more sense to try to put it together. So let's do this. Let me rewrite this over here in the middle and kind of go through and show you how the debits and credits work with the accounting equation. Okay? So the first one we have is we have the assets, right? And they equal what?
Liabilities.
Liabilities plus stockholders' equity. Now, they talked about something called a T account. And a T account is basically where we're going through and we just basically do this. A T account is really a ledger, which we'll talk about in one of the later chapters, but it's where we go through and record the transactions that are going to occur in that account. Now, we have something called a debit and a credit. And people are always trying to say, well, which one means increase or decrease? Or they don't. What they mean are just left and right. I think they're actually Latin or some strange language for left and right. So debits are always on the left. Credits are always on the right. Okay? Now, the reason you need to know that is because when you go through and you post a journal, you're going to have to record these accounts, each of these line items like accounts receivable and cash, or what we call accounts. And transactions that affect those accounts are going to be put into them. You're going to have to show if they increased or decreased those accounts. Well, assets are always increased by doing a debit. Why? Because whoever started this decided assets should start with a debit, I guess. Okay. And then that means that then the credit is going to be a reduction in assets. Think I have this here. On the other side, you have liabilities. Liabilities are always increased with a credit. So if you want to make an increase go up because you owe money to somebody, you're going to have to record that liability account with a credit. On the other hand, they go down with a debit because when you pay them, they're going to make them go away. You're going to do a debit. We're going to walk through some transactions. Maybe we'll make it a little easier. Stockholders' equity is the same way. It's on the other side of the equation, right? It's on the other side of the equal sign from assets. So anything on a stockholder's equity that's going to increase stockholder's equity is going to be a credit. Anything that's going to decrease stockholder's equity is going to be a debit. And that makes sense if you think about a simple transaction. Let's say we're going to go through and what's the first one they have here? Investment by stockholders on the bottom of page 15. Okay? If you go over and you look at the top of page 16, they talk about the change, and they say that assets went up by $15,000, right? And then stockholders' equity went up by $15,000. Well, what they mean is that when you did the journal entry, you had a journal entry for cash, and you did something look like this. You had a ledger, which has a debit and credit column. You wrote in cash, and you put a debit for $15,000 because assets are debited when they increase. Then you put stockholders' equity, and this would have been a common stock, would have been the type of account it was in. That's a stockholders' equity account. That would have been credited because you increase stockholders' equity with a credit. Your debits and credits always balance out because we want to make sure that those two sides are equal, and if we don't balance, then we know that we have some sort of a mistake in our accounting. So you're always going to have a debit and credit balance equal. You might have 3 credits that equal to 1 debit, so they don't have to be exactly the same number, but the two sides of every transaction have to record. So every time we have one of these transactions, we're going to be doing a journal entry. Now, that's the major accounts. There's also some other accounts that we do when we sell things, where we pay expenses and we receive revenue. And those accounts are over here on the stockholders' equity side. Let me kind of show you how that works. We have revenues, and then we have expenses. And the same thing happens here. We have debits on the left, credits on the right. So when we go through and we want to show an increase in a revenue is when we've sold something. So we sold something to a customer. Well, we're going to show the increase in their revenue as a credit. And the reason we're going to do that is because these revenues and expenses all increase the value or equity of our company. So we're going to go through, and ultimately these are both going to be included into our stockholders' equity account. So if I sold something, does that increase the value of my company, the equity of my company? It does. So the credit here is going to increase the credit up here when it gets moved in. So the value went up. Makes sense. You don't see this very often, but if you decrease a revenue, it's going to be done as a debit. Expenses are a little weird, though. Everybody gets confused with them. Because the way you increase an expense is you do a debit. So then what happens is people say, oh, expenses are like assets because they both have debits. No, they're not. Okay, that'll confuse you. Expenses are where we've used up an asset or we've used up something, we've incurred some cost of doing business. This is going to ultimately be included up here in my stockholders' equity. Well, if I spend money, say I pay wages, so I pay $10,000 to people, that's an expense. I debit salaries and wages expense for $10,000. When I combine this and put it up in here, it's going to go up here as a debit. What happens to stockholders' equity when you debit it? It decreases. Did paying that money to the employees decrease the value of your company? It did, because cash went out the door. So the expenses are debited not because they have anything to do with assets. They don't. They're debited because they're representing a reduction in the value and equity of the company, just like the revenues represent an increase. On the other side, you would have a decrease if you had an expense, would be with a credit. Okay? So it's really important to understand how these work, because you have these 5 types of accounts: assets, liabilities, equity, revenues, and expenses. You need to understand 2 things. When you see a transaction, you need to say, oh, that was a revenue account, or that was an expense account, or that was an asset account. So you need to be able to look at the transactions and identify them. Then you need to ask yourself, did that account increase or decrease? And then you go, oh, it was an expense account, it increased. Well, then I need to do a debit, because you know that expenses are increased with debits. If you understand how these 5 accounts are increased or decreased with debits and credits, you will save yourself so much time, because people will try to go through and read the book and memorize which accounts get debited and credited for every different transaction. And your head will explode, because there are too many accounts and too many different types of transactions to memorize. So after you get about 15 of them memorized, then your brain just shuts down. You can't remember them. So don't try to memorize them, analyze them. Ask yourself first, when a transaction occurs, am I talking about an asset, a liability, an equity account, a revenue, or expense? Usually it'll be 2. So maybe you bought an asset, okay? Or sorry, maybe let's do it this way. You received a payment from a customer, okay? They bought something from you. So you know revenues went up because that's a sale, and you got cash, so you know an asset went up. So you'd say, oh, okay, well, revenues went up, what should I do with it? I should do a credit. And an asset, cash went up, what should I do with it? I should do a debit. Hey, look, my credit and debit's equal. Yay. You don't have to memorize it, you have to analyze it, okay? You will save yourself so much time. So that's my first secret on understanding. Right there, hopefully, that gave you enough that this whole session was worthwhile. The other thing you might want to keep in mind, there's something we call normal balances. That means that the accounts have a balance that usually most of the transactions are either debits or credits. So with an asset, this is the normal balance. It's an asset, it's a debit. So normal balances are here. On liabilities, normal balances are on the liability side. I'm sorry, on the credit side. And in stockholders' equity, normal balances are also on the credit side. That doesn't mean that we never have transactions on the other side. It just means that most of them are going to be on the normal balance side, and at the end of the period, if there are balances that end because you have a transaction and goes all the way down, you add them all up, you'll normally have a balance on that normal balance side. Expenses normally have a balance on the debit side. And then revenues have a normal balance on the credit side. So hopefully that'll give you a little bit of information to help you be able to understand how the debits and credits work. Kind of a jump ahead on chapter 2 a little bit. Let's see, what else I want to talk about. They go through the different transactions, and this is actually a pretty good little way of writing it up, starting on page 16 and going through the 10 transactions. And I'll probably end up asking you, you'll definitely have to analyze transactions. So let's just go through a couple of those real quickly. What they do is they've got this set up, stockholders' equity, retained earnings, and have that written out, but we can kind of do it that same way. Any questions on this part? Is that making sense so far? Let's do a couple of these transactions just to walk through and give you an idea. And let's see how they do it here. I'm going to do it a little differently because I like to do T accounts. So I'm going to go through and I'm going to write each of these in. I'm going to use the T accounts. And it's going to be the same transactions that we're talking about here on page 16. So let's take a look at the first one, okay? That's on page 15. That's where you had a $15,000 investment in the business in exchange for $15,000 in cash. So you read through that and you say, okay, well, what accounts went up and what accounts changed? Well, the first one that went up is cash. Cash is an asset. So what I'm going to do is I'm going to make a $15,000 entry right here. The other side, it wasn't a liability because I don't have to pay it back. It was an investment by a stockholder. So I'm going to do a $15,000 credit to show that increase. It's actually going to be in common stock as the account it's in. The common stock is a stockholder's equity account. So that would be how I would record that transaction. And they show it in a little bit of an equation format. I'm just doing it in a T account. So you guys did T accounts in Chapter 2, right? So, yeah. On transaction number 2, you purchased equipment for cash. So what went up and what went down? Assets went up and went down. In this case, they're both on the same transaction side. You bought a piece of equipment for $7,000. So what's going to happen is you're going to see cash go down by $7,000 because it reduced, that's a credit, and you're going to see equipment go up by $7,000. So in that case, nothing was affected on the other side of the equation. It all happened on the asset side. And again, they break it out and give you the equation format. I'm just going to do it in the T account format. On transaction 3, what they did is they go through. That was a little trickier because they go through and you're purchasing something, supplies, and you're not going to use them all at one time. Plus, you're also not going to pay for it now. Okay? And they talk a little bit in there, and we'll talk more about that, the difference between cash basis and accrual basis. But when we go through and we have an exchange of value, but the cash hasn't happened, we have to go through and record that transaction even though cash hasn't happened. You and I, in our checkbooks, we don't put cash in until we receive it, and we don't take cash out until we write the check. But businesses have to use something called the accrual system, which means if the transaction has happened, but the cash is happening at a different time, you still have to record it. Chapter 3 will get into accruals and deferrals. But this is an example where you've received an asset because they've actually given you the supplies, but you have an obligation to pay in the future. So in that case, what's going to happen is you're going to have an increase of an asset. That asset is supplies. It's going to be $1,600. So you're going to debit it because the value went up, but you have an obligation to pay, which is a liability, and so you come over here and you have to show the increase in the liability by putting it into the accounts payable section. And accounts payable is where you owe money for purchases of items you're going to use in your regular business. So it could be supplies, it could be merchandise you're going to sell to your customers, it could be things that definitely something you're going to use for your business in the near future, but you haven't paid for it yet. Okay? And then you can walk through the rest of these and kind of see how they've set them up. There's equity. And we break that into the detail of the different types of transactions. And we'll talk about those a little bit more. That balance sheet is on a particular date. So it's on December 31st. It's what we had cash in the bank on December 31st. It's what inventory we had on the shelves on December 31st. It doesn't cover a period of time. The income statement is where we take the revenues that we've had during a period of time, say for a month or for a year, whatever our period is, and we put all the revenues together to see what our total sales were. We also take our expenses and we list them out by the type of expense. Was it cost of goods sold for merchandise we purchased and sold to our customers? Was it salaries expenses? Was it utilities expense, advertising expense, all the different types of expenses? And we list those out. We subtract the expenses from the revenues to see what our income was. So the income statement is where we're summarizing the results of running our business. That's where we see if we had a profit, the P&L statement, the profit and loss statement. Okay? And that is for a period of time. The retained earnings statement is where we're looking and seeing the change that happened in stockholders' equity. Retained earnings is part of the stockholders' equity account. And that's where we see not only the profits we had this year, but we look at the profits that we've retained or kept from the company from previous years, and we add to them if we have a profit. So we show that increase in the value of stockholders' equity by going through and looking at the increases in net income. If we paid out dividends, we subtract the dividends because that's giving some profit back to the customer or to the investors. Okay. The last statement is the statement of cash flows, and we'll get into that big time in the, especially in the second half, the 202 class. But that's where we look at the transactions where the cash is coming in from to the business and where the cash is going out from the business. And we try to group that together so we can identify where our cash is coming from and where it's going out. We group it in three categories. We do what we call operating activities, which is cash that comes in from selling things to our business, selling customer products or providing services to customers. And then we show the cash going out to pay for the bills and the expenses of providing that. Then we have financing or investing activities. That's where we use cash to buy long-term assets or buy investments. And then if we sold some of those, cash is coming in. If we buy them, cash is going out. And then we have financing activities, which is where we get cash into the company by borrowing or selling stock, or we send cash out by paying off debt or by paying dividends. So we want to look and see what the cash is doing coming in and out of the company so we can understand where cash is going. And we'll talk more about that. So those financial statements are all the different pieces that tie together, and we summarize all this information up.
I have a question. So the statement of cash flow is not going to be something that's on the test?
No.
Okay.
No, don't worry about that. You'll get to do that later.
Okay.
Yeah, you just need to know what it is. You don't need to do it. So that's kind of an overview of what Chapter 1 is. So again, look for the study tips and make sure that you know what's going on with those. And that'll give you will narrow you in a little bit more on the specific homework activities that you need to be doing. Okay? Let's see if this works.